Good morning and welcome back to another video for financial update. It is the 3rd of August, the first week of August, business week, and it is 5:28 a.m. on the West Coast. Let's jump into the financial news. So, the U.S. is in pretty big trouble right now, but I wanted to read this article here. What effect will lockdowns plus new stimulus checks have on markets this week? Fresh stimulus and new stimulus checks to some individuals is in the works. Wall Street is begging for it. But will an ever increasing chorus of governors calling for a return to partial lockdowns, not to mention lockdowns in Japan over the weekend, lead investors, both foreign and domestic, to cash out this week? For all eyes are now on the consumer. What shape are they in to keep the market going, thanks to unemployment insurance and money from the payroll protection program keeping most people solvent? Signals are now emerging that the initial boost from pent-up demand in early summer is fading. Consumers aren't all that interested in attending theme parks and retail en masse on 90-degree days. They are staying home. Consumer confidence is slipping lower due to government-enforced joy kills. So true. I'm staying home. I love being home. That, plus market concerns about labor markets, clouds the outlook and could be exacerbated if the government does not announce its final relief bill this week. It was expected last week. Yeah, we're in big trouble, guys. Renewed stimulus will backstop millions of workers afloat, especially those who were told to go home after a brief stint back in the gym. A brief stint back in the gym, the mall, or the local restaurant. Nice typo. Untold millions more are not expected to get their old jobs, according to one study by the University of Chicago published earlier in the pandemic. If true, that will be the second wave hit to consumer sentiment after the initial wave was protected people from a severe wipeout thanks to the government. Yes, it's not looking good. Let's see how it goes, but I don't even know if they've mentioned it yet, but I think a lot of people are about to have to start paying rent again, and they can't. Where are they going to go? Announcements of more lockdowns or schools opening and then reclosing will sour Wall Street. More talk of school opening policies is expected this week. Some investors will see a political angle, but all will see an economy and a society on pause if schools in the Northeast, the early epicenter and first to recover from the coronavirus outbreak, force students and teachers into hiding. The U.S. is flatlining. That's really how it feels, you know. I'm looking at the stock market and I don't understand it. Personally, I would get out. I'm not a financial advisor though. U.S. tech companies are doing great. We learned from last week's earnings report. Staying at home was profitable for companies dependent on its end user and to be plugged in as much as possible. Sadly, the U.S. and the world's equity markets are not powered by Silicon Valley and IT firms. The largest ever quarterly decline in U.S. GDP was all thanks to forced closure of businesses in the second quarter that benefited tech companies. Consumer services led by retail and hospitality were crushed. A recovery for those sectors is proving difficult due to extended lockdowns in California and New Jersey and a recent pause on reopening in Rhode Island, where the government there reduced the amount of people allowed at private parties, including outdoor gatherings. Okay. Jobless claims and high-frequency unemployment survey data for July show a worsening of labor market conditions. The Phase 4 spending package remains crucial, says Michael Gabin, an economist for Barclays in New York. Gabin thinks U.S. economic momentum will be more subdued and uneven in the coming months. It's already been uneven, with tech stocks leading everything higher. The new uneven means not everything is going to go up. The coronavirus trade, which was a play on beat-up stocks seen recovering from the end of the lockdowns, will be volatile again this week. Let's see. The best warning signs of the C19 trade not yet bearing fruit came from last week's jobless numbers. A second consecutive increase in initial claims and the substantial rise in continuing claims is as much a buzzkill for the market as is going to Disney in a surgical mask. Right. Yeah, Disney's really not doing well. No movies, no theme parks, no sports. They're screwed. An unpublished private sector survey showed that a little under 60% of workers that were laid off due to lockdowns reported being put back on payroll in June. The rest said they were not asked to come back to work yet, even as lockdowns were lifted nationwide. High frequency data from the Census Bureau's Household Pulse survey has also showed a decline in employment of about 500,000 between mid June and mid July due to lockdowns and business owners simply not seeing the consumer traffic to warrant bringing back staff. The census survey predicted the June change in employment, whereby employment in the HPS rose 1.5 million and the increase in private sector employment in the household rose 4.9 million. But the direction of the HPS July data points to a deterioration in the labor market conditions 2 months after states reopened. The June trend has been flatlined. The market has been ignoring this until recently. The only thing holding the market up is the Fed and Treasury, still with plenty of firepower to save the publicly traded companies and the retirees invested in them from a depression era like bloodbath. Oh my goodness. Fed Chair Jay Powell told us that the Fed is not thinking about thinking about. Yes, he added a third thinking about raising rates. This is Dan Russo, Chief Market Technician at Jaycon Analytics. Thought that was a typo. The Dow Jones Industrial Average closed lower on the week in the small to mid-cap Russell 2000, which is heavily weighted towards companies whose sole business bases in the U.S. underperformed the S&P and the Dow. Gold is still looking golden for the week. Bonds, especially developed market debt, are looking useless. Great. What's so great about gold? Here we go. California, Texas, and Florida are number 1, 2, and 3 in terms of population and 1, 2, and 4 in terms of GDP in the U.S. The fact that the virus is spiking in all of these states is bad news for the economy and is likely bad news for the market. A double spike in infections might lead to a double dip in the market, warns Mark Otto, client portfolio manager at Swan Global Investments. Traditionally, bonds have been the safe harbor, but with yields at historic lows, investors are looking to alternatives to fill the capital preservation role. Says Otto, gold has been a beneficiary of this move. Trillions of dollars of new money has pushed gold to record highs. I am telling you, folks, there's something going on. They're even telling us that bonds are not the play. Like, in a situation like this, you think bonds would be where to have your money. They're generally safe in a situation like this, and gold is still sitting pretty near its all-time high. Silver's doing nicely too. Just barely dipped at the beginning of the opening of the market. No big deal. Barely touched. I'd start hedging your bets. Bonds are no longer able to provide that dual role of capital preservation and income. Investors need choices. Hedging strategies using options have been a lot of growth, both in terms of the products available and assets under management these last few years. We expect that trend to accelerate, he says, adding that from the market's view right now, bonds are dead money. Okay. Maybe it's time to sell those bonds. Here I got another one. Massive consequences are coming. This one's from Zero Hedge. A new month and what new madness for markets is the question. Non-farm payrolls is the big one due on Friday. What will it tell us about the state of the U.S. economy and indication for the globe? More of the same, I expect. We will remain constantly looking over our shoulders and wondering about market risks, disbelieving the current euphoric valuations versus the frankly miserable outlook. We'll keep trying to guess how the global economy is changing and where the threats and opportunities lie, all the while working out what central banks will do next and wonder how to arbitrage their actions and trying to overlay our outlooks with the C19. What about the C19? For every economic release that seems to suggest underlying global economic resilience, it feels like there will be an equal and opposite force in the form of renewed social distancing, travel restrictions, or even lockdowns a second wave where hotspots threaten. Renewed restrictions feel likely to strangle any real economy. It's not just me that's wondering if this is any way to run an economy. Headlines everywhere about how the insidious little C19 beast is wrecking our lives and economies. I can't help but wonder, what if some tech genius can invent a... Yeah, talking about the little thing from Men in Black, the little memory wiper. I don't need to read about that. This morning, the UK government is in a flap about the possibility of mandating over 50s to shield. I guess that means if you're over 50, you're going to have to start wearing a face shield. Since I passed that particular milestone a while ago, I've already had the heart attack and remain somewhat cuddly, according to my wife and morbidly obese doctor. Oh, and you're morbidly obese according to my doctor, so you have to wear the shield. Great. I'm struck by investment analyst headlines warning markets can't deny economic gravity indefinitely. Actually, they can. The reality of the last 5 months since March is that you can't fight global banks. QE Infinity version 2.1 distorts markets even more dramatically than the original QE 1.1, which simply distorted markets by keeping rates artificially low. When it all goes inevitably wrong, because it will, the QE X Power 3.1 will see markets bailed out again and again. But here comes the massive consequences for that. Last week I wrote about how QE has created financial asset stagflation, meaning savers, and particularly pension savers, are in serious trouble as returns have essentially flatlined. To reiterate a point I made many times, 10 years ago, is that a pound? I don't know what that is, what symbol that is. 10 years, £1 million pension fund would buy you a very comfortable retirement income. Today it won't even buy a train season ticket to keep working up in London. That's a serious issue in terms of disincentives to save, but also a rising social issue likely to trigger dissent and unrest as unions and workers demand retirement benefits. If we just paid $2 trillion to bail out the economy from you-know-what, how much will the unfunded pensions crisis cost the economy? Oof, what will that pensions and C-19 spending crowd us? If we are using the nation's resources to fund retirement, then how much is it not being spent on desperately required reform of the NHS or education, and how much is not being allocated to required infrastructure projects? This morning, let's talk about another consequence of QE distortion on the economy, directly by distorting businesses. Let me skip that paragraph. We all know that replacing the invisible hands of markets with the dead hand of state control is one route to disaster. Agreed. But there are plenty of others. All distortions lead to inefficiencies, the rise of bureaucratic mindset, and satisficing strategies where companies are free to milk revenues with little regard to cost or customer choice. I've never heard that word. That might be a typo. As the global economy continues to reel from you-know-what septic shocks, I suspect it's only a matter of time before we see QE 3.1 max power propel markets even higher when global banks cut the bluff and just start buying company equity directly. There will be subsequent iterations, including purchase of commercial property and maybe even real assets. Who knows where it all eventually leads, but if you're trying to understand where today's markets are headed, then understand the reality. It's going to remain about as desperate distortion as central banks keep playing whatever cards are left to stay in the game. While this crisis lasts, playing market is all about playing that distortion. Listen politely to what analysts and city writers are saying about overbought markets and financial resets, and follow what the central banks actually do. At some point, the penny will drop or the dam will burst. We are going to have a financial reset. It seems pretty quite obvious. And I think it looks like having cash and most of your savings in USD is going to be the way to get hurt the most by everything that's coming. Over the weekend, I did notice that Bitcoin dropped to about 1,100. It like just hit 12,000 and then dropped. You know what? If you've been watching the crypto prices like I have for the last few years, you know this is normal. You know we get a price breakout and then someone or some groups just sell it off. They've made their profit and they sell at 12,000, and I think about $1 billion was sold, which dropped the price to 1,100, and it's still holding. Ethereum's doing fairly well too. I mean, it's holding at 387. It's up. Ripple is up to 30 cents. Ripple was 20 cents 3 days ago. So Ripple's looking nice. Yeah. Binance Coin's performing well. I mean, overall, typical. I'm still very, very, very bullish on crypto and the top 20 altcoins for this year. I still think we're in a very, very bullish place for them, particularly with what's going on with fiat currencies like the USD. They're just printing it. The markets in America, the stock market is just an interesting place to have your money right now. And I think a lot more people are going to be safer in crypto and gold right now. On Sunday morning, Bitcoin saw a move down from 1,149 to 10,550. Prices were quick to partially recover as the next 30 minutes saw buyers push prices back up to 1,236. That's what I missed, I guess, because when I went to bed it was at 12,000. When I woke up it was back at 11,100 ish or so. So, yep. However, the 4-hour and daily charts continue to indicate strength, with the Pioneer digital asset remaining above its 34-day and 50-day exponential moving averages. The move took out over 800 million to 1 billion in longs. The block director of research, Larry Kermack, tweeted. He noted that the largest single liquidation order happened on BitMEX's Bitcoin perpetual swap, adding most of the liquidations, about 647 million, came from Bitcoin's futures, followed by Ethereum with 165 million of liquidations. The volatile move was the most in recent weeks. Bitcoin largely traded between 9,200 and 9,500 for the most of June and July, but developments around Ethereum and the DeFi market has resulted in positive inflow towards the broader cryptocurrency market. Yeah, people are obsessed with DeFi, and I don't even care. I guess maybe I've already had some DeFi coins. I guess Ethereum is the big DeFi coin. It's just that I never heard the term DeFi being used so much, which makes me think Ethereum and Cardano are going to be big winners. Today's drop comes after Bitcoin rose nearly 30% in the past week, from 9,300 to over 12,000. Other cryptocurrencies followed suit, with Litecoin, Zcash, Ethereum rising between 20 and 35%. Meanwhile, data shows American citizens have poured in over 67 billion into Bitcoin and other large cap cryptocurrencies since the start of 2020, indicating massive retail interest and money entering the market. Yep. It's going to be a super interesting week. It's interesting when I do these videos so early, we still have 45 minutes to go before the actual New York Stock Exchange opens, and I'm very curious to see what the market's going to open at today. Not that I'm super invested in it anymore, because I'm not. I've literally got most of it is sold. I wanted to get out, and I saw a moment to do that, in which I've been making profits over the last few years, so I was in the green. I got out, with the exception of a few stocks that are not in the green. But I have definitely moved much further into precious metals, and I've been investing in crypto since the crash of I think you call it early 2018, when Bitcoin hit around 20,000 and then dropped. It was a major, a big bull run ended with a big bearish crash. It's how they always go. I could have sold and made pretty easy, quick money, but I didn't want to. For me, I see the really, really long-term potential for Bitcoin, especially right now when it looks like the US dollar is not going to be the world's reserve currency for much longer. Like I said, like other people were saying, it's going to take a much less corrupt government to come up with theirs, or maybe there's going to be some new gold-pegged currency or crypto-pegged currency out there. I don't see the world wanting to trade with our dollars for much longer anymore. We will see. Anyway, that is the financial news for today. This is a much newer channel, folks. If you are liking this kind of content, feel free to subscribe and smash that like button. I generally don't want to always ask for these things, but as it's a new channel, I have barely any subscribers at all, and those things really do help others see this kind of stuff. So, thanks so much. Have a great day.